Have you ever wondered how a single problem can spread across an entire economy and cost millions of people their jobs? It doesn't happen overnight. It starts with one financial domino. Imagine a small business that suddenly sees fewer customers. Sales begin to fall. At first, the owner thinks it's just a slow month. But the slowdown continues. To save money, the business stops hiring new employees. Then it cuts overtime. Eventually, it lays off workers. Now those workers have less money to spend. They stop eating out, delay buying a new phone, cancel vacations, and avoid unnecessary shopping. Suddenly, restaurants, clothing stores, and electronics shops also start losing customers. Their sales fall too. Now they begin cutting jobs. Another domino falls. Banks notice that businesses are struggling and become more careful about giving loans. Companies that wanted to expand can no longer borrow easily. New projects are cancelled. Construction slows down. Suppliers receive fewer orders. Factories reduce production. More workers lose their jobs. Another domino. As unemployment rises, people become worried about the future. Even those who still have jobs start spending less because they're afraid they might be next. This fear becomes a powerful force. Businesses earn even less money. Stock markets often react by falling because investors expect company profits to decline. When stock prices fall, many investors and retirement funds lose wealth. People feel poorer, so they reduce spending even more. Another domino. Soon, what started as one company's problem has spread through shops, factories, banks, markets, and households across the country. This is how a recession grows, not because one giant event suddenly destroys the economy, but because thousands of small financial dominoes keep knocking each other over. The good news? Dominoes can fall in the opposite direction too. When businesses start hiring again, people earn more. They spend more. Companies receive more orders. Factories increase production. Banks become more confident to lend. Investment returns. Confidence comes back. One positive domino creates another. That's why governments and central banks often step in during recessions. They lower interest rates, increase public spending, or support businesses, not to eliminate every problem, but to stop the dominoes from continuing to fall. The next time you hear the word recession, don't imagine one massive crash. Imagine the first domino, because understanding that first domino helps you understand the entire economy. Have you ever wondered how a